Joining us now is Mercer's U.S. CIO, Olaolu Aganga. She manages the U.S. portfolio of Mercer's $379 billion in assets. Mercer's a financial services advisor to large funds like pensions, retirement plans, and endowments. Olaolu, thanks for being here with us on set.
Thank you for having me.
So large asset owners have trimmed exposure to U.S. stocks. But what does that mean about what happens from here? Is that just being maybe redeployed now? Is there further trimming that might happen based on what we see with these earnings coming up?
So we really pay attention to the large asset owner survey, of course, because these are clients that tend to have, call it, $5 billion plus in assets. This survey represents over 60 clients, $2 trillion, so really market moving. Some have trimmed, but even in the next year, they've indicated their willingness to trim further. So U.S. equities, U.K. equities, and real estate. Not surprising.
So how does this global geopolitical instability, war in Europe, war in the Middle East, tend to affect the mindset of large asset owners? It seems to not be having a huge impact now. Is consumer behavior or even retail trading a bigger influence?
So what's happening right now is adding, definitely a sad situation, but really adding to additional uncertainty. Geopolitical events are just hard to predict the impact on markets. So it tends to be volatile at first, then it dissipates. So we're not really advising clients to act on that per se, but it's just adding to the additional uncertainty. So as they look forward, and just to add to the question that you asked initially as to where they're deploying assets, they're really more looking to add in private debt, in infrastructure, in private equity, for example. So trimming in one area in public markets, but adding in private markets.
What is so attractive about private markets right now versus public?
I'll give an example for infrastructure. So infrastructure has inflation-oriented abilities that can protect your portfolio. The opportunity set, both in the U.S. and in Europe, has increased. So if you think of the Jobs Act, billions of dollars that have gone to states, local governments for bridges, tunnels, increasing water capacity. For Europe, we also see Repower EU. That's another initiative that's focused on more green energy, sustainability aspects as well. So infrastructure opportunity set has been increasing in the last couple of years, coupled with the inflation protection for portfolios gives a rich opportunity set.
So things like private credit, I mean, fixed income, something we've been talking about a lot. You're seeing higher yielding fixed income opportunities, both in private and public markets. Is this compelling, especially when you're talking about institutional investors coming off of a year last year where basically nothing did well?
Absolutely nothing did well. Equities and bonds down double digits is a statistical anomaly. Now, yields or the higher yields, yes, it's good in portfolios. What that's really done is allowed asset owners to rethink their risk appetite. So you don't really need to take that much risk to get higher yields. If you think of just the U.S. ag, for example, you're earning, call it 5 3/4 just sitting in the ag. So it's expanded the bond opportunity set, but without as much risk that people have needed to take in the past to get that type of return.
Olaolu, what about commercial real estate and maybe even specifically office? We hear rumblings that there are very wealthy people licking their chops for when these loans roll over and some of these buildings get repriced. What are you seeing?
So usually, and even if you're to look back in history, it's some of the more distressed periods in the market. That's when opportunities open up. So now it's, given where rates are and cap rates especially, it's challenging for things like real estate. But we would take a step back, not necessarily make hard decisions. We're seeing large asset owners looking to trim some of those areas, but it still poses opportunities if you were to look from an active management standpoint and areas that you can sift through to be able to see where you can find that in your portfolio.